98 million ounces. That's all the registered silver currently sitting in COMEX vaults right now. Just 98 million ounces. And in 6 days, on February 27, 2026, the March futures contract hits first notice day. That's the critical moment when holders of 429 million ounces worth of open interest can stand up and demand, "Give me the physical metal." 429 million ounces of potential demand, 98 million ounces of supply. You don't need a finance degree to see the massive problem staring us in the face. Current prices as I'm recording this on February 21st, 2026. Silver spot price is trading at $80.46. Gold spot price is hovering near $3,000. Markets are closed for the weekend tomorrow, and the clock is literally ticking down to what could be one of the most significant events in precious metals market history. I cover both bullish and bearish scenarios with verified data, because that's the only honest way to operate in this space. Subscribe if this content adds value to your understanding. Don't subscribe if it doesn't. It's that simple. Now let's get into the details of what's really happening. Let me give you the complete picture, because what's about to happen on February 27th, 2026 has been building for months, and almost nobody outside of our precious metals community is talking about it with real, verified numbers. Here's the core structural problem that's been developing. COMEX registered silver has been draining at approximately 785,000 ounces per day. Back in October 2025, registered inventory sat comfortably at 167 million ounces. Today, on February 21st, 2026, it stands at just 98 million ounces. That represents a catastrophic 41% collapse in registered silver in roughly 4 months, and the drain rate is actually accelerating, not slowing down. At the current drain rate of 785,000 ounces per day, by the time February 27th arrives next Thursday, we could realistically be looking at inventory levels closer to 90 million ounces, possibly even less. Every single day that passes, nearly 800,000 ounces are walking out the door and not coming back. Now, look at the opposite side of this equation. March open interest currently stands at 429 million ounces. That's the paper demand sitting directly across from a nearly empty vault. This is the mathematical impossibility that has everyone in the know watching this situation with extreme attention. Here's what history tells us about typical delivery rates in commodity futures markets. In a normal month, somewhere between 5% and 20% of open interest stands for physical delivery. That's how the paper futures market has always survived and functioned. Most contracts roll forward to the next month. Most holders take cash settlement instead of physical metal. The system was designed this way, and it's worked for decades. But February 2026 has not been a normal month, not even remotely close. Almost the entirety of the initial open interest in the February contract demanded physical metal delivery, and they were joined by a massive flood of mid-month buyers doing the exact same thing, coming in, buying contracts, immediately demanding delivery, taking the metal, and leaving the exchange. That behavior has never happened before in a non-primary delivery month in the modern history of COMEX. January 2026 delivered a staggering 49.4 million ounces of silver, which was 7.27 times the level for January 2024. Something has fundamentally changed in how market participants are treating these silver contracts. They're not rolling them forward anymore. They're demanding physical metal, and they're leaving the paper market entirely. About 75% of you watching this video right now are not subscribed to the channel. If this unbiased, real-time analysis is helping you cut through the mainstream media noise and make better informed decisions, please hit that subscribe button. This community is built on truth and verified data, not hype and fear-mongering. Drop OG John AG in the comments section so I know who's actually here, and engage with this content. So what realistically happens on February 27th, 2026? There are exactly 3 possible paths forward, and I want you to understand all 3 scenarios clearly, because this is absolutely not a time for wishful thinking or hopium. Let's examine each one. Path 1. COMEX finds the metal holders of eligible silver, which is silver sitting in COMEX-approved vaults, but not yet officially classified as registered, could convert their inventory to registered status at current prices. Eligible silver totals considerably more than registered silver. On paper, there's theoretically enough metal available. But here's the critical catch that changes everything. Those holders of eligible silver are watching prices carefully. They've been watching silver prices crater from $121 per ounce down to $65, then recover back to $80 where we are today on February 21st, 2026. They're not going to voluntarily hand over physical silver at paper prices that many industry experts believe are still artificially suppressed through derivatives and high-frequency trading. The financial incentive to convert from eligible to registered status simply isn't there at current price levels, which is precisely why eligible silver has been sitting in place while registered inventory continues to drain day after day. This path is theoretically possible, but the numbers and market behavior suggest it's becoming less likely with each passing day. Path 2. Cash settlement is imposed. This is the scenario where COMEX officially says we cannot deliver physical metal to every contract holder who demands it, therefore we will settle outstanding contracts in cash at the current paper price. This has happened before in other commodity markets during extreme stress periods. It's completely legal under exchange rules. But here's what cash settlement actually means in practical terms. It means the paper price is no longer backed by physical reality. It means every institutional buyer who entered that futures market expecting physical delivery gets handed US dollars instead of actual silver, and it means the credibility of COMEX as a legitimate price discovery mechanism takes a historic hit that it may never fully recover from. If cash settlement happens on or after February 27th, watch the Shanghai Gold Exchange premium immediately, because the physical market will not care what COMEX says the price is anymore. Shanghai becomes the new global reference rate for actual physical metal. Physical dealers worldwide will set their own prices based on actual supply and demand. The paper market loses its authority and relevance overnight. Path 3. Force majeure. Declaration force majeure is the nuclear option. It's an official legal declaration that COMEX cannot fulfill its contractual obligations due to circumstances beyond its reasonable control. The exchange suspends deliveries, trading halts entirely, or is severely restricted for an indefinite period. This is the scenario that would fundamentally reshape the entire global precious metals market overnight, possibly permanently. I'm not saying force majeure is the most likely outcome. I'm saying it's now a scenario that has to be seriously on the table given the mathematical reality we're facing. And the fact that we're even having this conversation as a realistic possibility tells you everything you need to know about how far outside normal market conditions we're currently operating. Here's the mid-video data point that reframes this entire situation. On January 30th, 2026 alone, 1.98 billion ounces of silver were traded on COMEX. One single trading day. Let that sink in for a moment. In a world where total annual global mine production is approximately 800 to 850 million ounces, they traded more than twice the entire world's annual silver production in just 24 hours. That's not legitimate price discovery. That's not a market functioning normally and efficiently. That's a machine specifically designed to manage price perception, not to reflect physical reality. And that physical reality is now catching up in a dramatic way. The one-year silver swap rate minus U.S. interest rates is currently showing market imbalances and stress levels larger than the 2008 financial crisis and larger than the 2011 silver mania. Those were the two most extreme silver market dislocations in modern financial history, and the current reading as of February 2026 exceeds both of them significantly. That's not hyper-speculation. That's objective data telling you the structural tension in this market is at historic extremes that have no modern precedent. Now let's address the physical market side, because the vault math only tells half the story. What's happening on the ground with actual dealers and refineries is equally alarming. In the first 4 days of February 2026, COMEX recorded 14.8 million ounces in silver delivery notices in what's supposed to be a non-primary delivery month. To put that in proper context, that nearly matched the entire delivery total for all of February 2025. At the close of trading on January 30th, 2026, open interest in the February contract was just 1,231 contracts. Within 2 trading days, 2,955 delivery notices had been issued. That's 2.4 times the total open interest demanding physical delivery. What does that tell us? New buyers were entering the market, demanding immediate metal, taking it directly out of the vault and leaving the exchange. That's why open interest stayed relatively low. They weren't speculators playing the paper game. They were serious buyers with immediate demand, and those buyers aren't stopping. The demand is intensifying as we approach February 27th. Bullion Star, one of the most respected and established physical dealers in Asia, posted publicly that sourcing physical silver has become near impossible. Mints are closed or operating at reduced capacity, refineries are massively backlogged with months-long wait times, and competitors' shelves are empty. Golden State Mint in the United States completely shut down silver sales because they simply couldn't secure adequate supply to fulfill orders. Baird & Company, the United Kingdom's largest precious metals refiner, shut down their online sales platform entirely due to supply constraints. The paper market says there's plenty of silver available. The physical market says there absolutely is not. One of those two markets is lying to you, and I can guarantee it's not the dealer who literally cannot find metal to sell to customers. Now let me give you the completely honest risk assessment, because this channel doesn't exist to tell you only what you want to hear or to confirm your biases. The scenario where February 27, 2026 passes without major incident is absolutely real and possible. If enough eligible holders convert their silver to registered status at current prices, if enough long position holders roll their contracts forward to May rather than demanding immediate delivery, if the intense institutional demand that's been hammering the physical market softens heading into the weekend, any combination of those things happening could delay this reckoning. Paper markets have surprised observers before. The financial establishment has resources, connections, and mechanisms that we cannot fully see or understand from the outside looking in. The CME has already hiked margin requirements 3 times in just 10 days during late January and early February 2026. That's them using every regulatory tool available to force liquidation of long positions before first notice day arrives. Those aggressive margin hikes took the cost of holding a single 5,000-ounce silver contract from roughly $25,000 before January 28, 2026, to well over $66,000 today. That's massive financial pressure designed to flush out leveraged players. And that pressure has been working to some extent. Long positions have been liquidated, weak hands have been forced out of the market, speculators using excessive leverage have been eliminated. But here's what margin hikes fundamentally cannot do. They cannot create physical silver that doesn't exist. They can force paper longs to exit their positions. They absolutely cannot force the physical shortage to magically disappear. And every single day that passes between now and February 27th, another 785,000 ounces leave the registered vault. The mathematical drain doesn't pause for margin hikes or regulatory intervention. Here's specifically what I'm personally watching between now and next Thursday. Watch the daily registered inventory updates. Any acceleration in the drain rate is a clear signal that pressure is mounting exponentially. Any sudden spike upward in registered inventory means eligible holders have converted, and that's a pressure relief valve opening that could delay the crisis. Watch open interest in the March contract. If open interest collapses dramatically in the next 6 days, that tells us longs are rolling forward and exiting, reducing immediate delivery pressure. If it holds near current levels of 429 million ounces approaching first notice day, we're heading directly into a genuine delivery confrontation with no easy resolution. Watch the Shanghai premium closely. Right now, as of February 21, 2026, premiums have compressed significantly from the extreme 43% levels we saw during the February price crash. If that premium starts expanding again in the coming days, if the gap between Eastern physical prices and Western paper prices starts widening dramatically, that's the physical market telling you that paper pricing is losing the fundamental argument again. Watch Bitcoin. I know that sounds unrelated to silver, but the correlation data is absolutely clear. Every major sell-off in silver during this current cycle has been led by Bitcoin weakening first by 24-48 hours. Bitcoin is functioning as the canary in the coal mine for overall risk appetite. If Bitcoin stabilizes and builds a solid base over the weekend, risk appetite returns across all alternative assets, and silver has room to move higher. If Bitcoin rolls over and breaks support levels, expect correlated downside pressure in precious metals, regardless of the underlying supply fundamentals. Let me leave you with 3 critical takeaways as we head into this historic week. 1. February 27, 2026 is not just another date on a calendar. It's a genuine structural stress test of the entire precious metals future system. 98 million ounces of registered silver standing against 429 million ounces of potential delivery demand. Those numbers have never been this mathematically far apart in the modern history of this exchange going back decades. Something absolutely has to give. Either the paper market finds a creative way to manage it through the 3 paths we discussed, or the physical reality forces a resolution that restructures the entire market. There is no third option where nothing happens. 2. The drain is not slowing down, it's actually accelerating. 785,000 ounces per day leaving registered vaults, physical dealers globally unable to source adequate supply, a February 2026 delivery rate of 98% that completely shattered every historical precedent and norm. The market structure isn't just flashing warning signs anymore. It's flashing a full-blown red alert in every direction simultaneously. 3. This is not a prediction. This is a risk map. The possible scenarios are laid out clearly before you. The mathematics is transparent and verifiable. What happens on February 27, 2026 will either validate the concerns about physical shortage or temporarily delay the reckoning, but it will not fundamentally change the underlying reality that 98 million ounces cannot possibly satisfy 429 million ounces of demand if those contract holders decide they want physical metal. The structural imbalance doesn't magically disappear after February 27th passes. March 2026 becomes the new pressure point, then May 2026, then July 2026. This situation doesn't end on a single date. It either escalates progressively or the system breaks under the mathematical impossibility. Whatever your personal position in this market, whether you're a long-term physical stacker, a short-term trader, or simply someone watching this historic situation unfold from the sidelines, have a concrete plan, not just a hope. Hope is not a strategy in markets this volatile. Drop OG John AG in the comments section below. Tell me what you honestly think happens on February 27th, 2026. I genuinely want to see how this informed community reads the situation based on the data we've reviewed today. The next 6 days will be absolutely critical. I'll be monitoring every development closely and will update you with any significant changes to registered inventory, open interest, or market behavior. Stay informed, stay rational, and most importantly, stay prepared for whatever comes next. I'll see you in the next video.